Hi, this is Roger Conrad. I'm co-editor of Portfolio 2020 and chief strategist. And what I want to talk to you about today is sort of an overall comment on the letter. You've seen some postings about, I think, some very interesting industries. That remains our primary goal. But what I want to talk about today from a general strategic front is just the fact that I'm pretty bullish going forward in 2010. I read a lot like everybody else who covers the industry. I read a lot about individual companies. I read a lot of overall commentary. I read a lot of popular media. Basically, I think there is a favorable juxtaposition of those three sources as I look into 2010. For the one thing, the company news, I think, on the individual companies level, down on the ground, is pretty positive. Those that have made it through the difficult period, and of course, I really calculate the recession and bear market starting in the middle part of 2007. So companies that have made it through all of that are in pretty good shape going forward. And in fact, we're seeing more and more positive outlooks and positive reports on those fronts. So I think that's, and at least as far as the expectations go for companies, they remain fairly negative. So I think there's a tremendous ability for companies to beat expectations, maintain dividends, maintain balance sheet strength. And again, that's very positive going into the new year. Where valuations are still fairly low. The second media stream, some of the economic news. This has definitely been a very up and down picture over the past couple of years, and it's very much the overall big picture, I think, is very much a bifurcated economy, just as a bifurcated market. Some entities, big corporations, healthy corporations, healthy individuals, well-heeled individuals are finding absolutely no problem getting lots and lots of credit, and at some of the best rates in generations. On the other hand, anyone who needs money, be they a company or an individual, is having a lot of trouble getting it. One of the small companies that I follow, for example, was just forced to roll over a credit agreement with an 18% interest rate. That's not good in any environment, and it's especially bad when you see larger companies out there that are able to get money under the same, roughly the same duration or same maturity for 3%, 4%. That's obviously a huge advantage to the better heeled companies, to the financially healthy companies, and a very good reason to steer clear of the weaker fare out there. Same thing on the larger economic front. Some of the indicators that we've got have been pretty positive. Some of them have been, on the other hand, fairly negative. So it's created this, I think, great sense of confusion about where things are headed, and that's been more or less the overall markets. What's been hanging over the overall market, and that basically on the days when the news comes out good, we see the markets rally. On the news when things are bad, we see the markets sell off. And interestingly enough, a lot of the companies and investments that are considered interest rate sensitive have become very economically sensitive, and they have, as they have been for the past couple of years. In a traditional market, for example, you'd see utilities selling off when the overall market or economic news was very strong. In this market, they go right along with everything else. So it's a very, very different dynamic, but it's one where you have, say, treasury bonds on one side that rally when the economic news is bad, everything else on the other side. That's very bullish, I think, going forward as the economic news continues to improve. And I think if you take a step back, you'll see that that's what's happening. Now, contrasted with those two bullish scenarios on the other side is the popular press. And there pretty much everything is negative. And there's a lot of reasons and a lot of worries out there. And I see those conveyed in the correspondence that I do with investors, and that is people are worried about everything from a double dip recession, which is very, very unlikely, more inflation, which is likely but not now, and particularly there's no wage pressure as there were in the wage pressures as there were in the 70s, which are really one of the major factors behind the inflation there. There are higher commodity costs and so forth, and these are, I think, in some ways recessionary, but we're certainly a long way from 70s style inflation. You know, the credit markets are another thing people worry about, but again, big corporations are recapitalizing their balance sheets. A lot of companies haven't started, you know, really hiring back in full swing, but they have been building their balance sheets. They have been doing things that make themselves much more bulletproof going forward. So again, not an instant recovery, but one that is slowly building. And you know, I think you put all these things together, good things on the ground, good things happening on the ground, even good things happening on the 3,000 feet level, and extremely negative sentiment, and you really have the makings for higher share prices down the road. Again, why? Well, because bad sentiment means a low bar of expectations. Better news for companies, better news for the economy means it's easier to beat those expectations. So that's pretty much the way I look at things going forward. You know, if you look at the Portfolio 2020 lineup, you'll see in companies that are pretty much wired into long-term trends. These are things that have transcended the downturn. So that's another reason to be very bullish. I think this will be a year where they really start to capitalize more on increased spending and on more demand for what they offer. And we have seen some of these pick up. You'll see that some of the share prices are actually above the buy targets, and I'd like to urge everyone to please stick to those buy targets. There are, at any given time, a number of companies out there that are below the buy targets. We're always on the lookout for more stocks that are good values, but please stick to the buy targets, as that's the only way you're going to get in at the right prices. And if you do that, and you look at the quality of these investments, again, they've weathered the downturn of the past couple of years. They participated fully in the rally that's followed since early March of last year, and they're, again, in very, very good shape because they're positioned in these long-term immutable trends. So that's basically all I have to say. Please take a look at the new articles that are up. Take a look at the portfolio. We do actively manage it, and if you own any of these stocks, anytime there are changes perhaps in buy targets or in advice, so you know, please keep up with that. And we're looking forward to, again, a very profitable 2010 and on beyond. So thanks for tuning in. Look forward to chatting with you next time.